Legal disclaimer. The content presented in this video and throughout this entire series is strictly for educational and entertainment purposes only. It does not constitute financial, investment, legal, or tax advice. Foreign exchange trading, commonly known as Forex, involves a significant level of risk and may not be suitable for all investors. The high degree of leverage available in Forex trading can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. There is a possibility that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. You should be aware of all the risks associated with foreign exchange trading, and seek advice from an independent financial advisor if you have any doubts. Historical performance of any trading system or methodology is not necessarily indicative of future results. We are not financial advisors, and we are not recommending that you buy or sell any specific currency pair or use any specific platform. You are solely responsible for your own financial decisions and the due diligence required to verify the regulatory status of any broker or application mentioned or implied. Let's be brutally honest for a second. There is a very high probability that the trading app currently sitting on your phone is designed to make you lose money. That is a controversial statement, but we need to start this masterclass with eyes wide open. You have likely heard the statistic that 90% of retail traders fail. It is a number thrown around constantly in this industry. But what no one tells you is that a significant portion of that failure rate is not because the trader picked the wrong direction on the Eurist or misread a candle pattern. It is because they are fighting a war on a battlefield that is rigged against them. They are trading on platforms that suffer from intentional latency, platforms that widen spreads specifically when volatility hits, and platforms that are technically legally registered, but operate in gray zones where your capital is about as safe as cash in a burning building. We are living in the golden age of accessibility. 10 years ago, accessing the interbank market required clunky desktop software, expensive data feeds, and a rigorous approval process. Today, you can download an app while waiting for your coffee, link a bank account, and leverage your life savings by 50 to 1 before the barista calls your name. This ease of access is a double-edged sword. It has democratized finance, yes, but it has also gamified risk. The App Store is flooded with slick, beautiful interfaces that look more like video games than professional financial tools. They shower you with confetti when you deposit, they use bright colors to trigger dopamine responses, and they hide the critical data, the stuff that actually matters for your survival, behind simplified line charts and by buttons that are far too easy to press. The problem is that most beginners choose their Forex broker based on who has the best welcome bonus, or who had the coolest ad on social media. This is the financial equivalent of buying a car because you like the color of the paint, without checking if the engine works or if the brakes are cut. If you choose the wrong app, you are not just risking market exposure. You are exposing yourself to counterparty risk, withdrawal nightmares, and execution manipulation. You could be the best technical analyst in the world, but if your broker is trading against you, taking the other side of your position and profiting from your losses, you are swimming upstream in a river of concrete. This brings us to the promise of this deep dive masterclass. Over the next 10 parts, we are not just going to list 5 popular apps and tell you which one has the lowest fees. That is surface-level content that you can find anywhere. We are going to build a fortress around your trading operations. We are going to construct a professional-grade vetting process, a complete, uncompromising checklist that you will use to evaluate any financial software before you trust it with a single cent of your hard-earned capital. This series is designed to solve the paralysis of choice and the danger of ignorance. By the time we are finished, you will understand the plumbing of the Forex market. You will know the difference between an ECN broker and a market maker, and why that distinction determines whether your broker is your partner or your adversary. We are going to dissect the user interface not from an aesthetic perspective but from a functional one. Does the app allow for one-click trading? Does it support complex order types like trailing stops and OCO orders? One cancels the other, which are essential for risk management. Or does it force you to market execution only, guaranteeing you get the worst price possible during high-impact news events like the non-farm payrolls? We will look at the regulatory landscape in the United States versus the rest of the world. The regulatory environment in the US is incredibly strict, overseen by the NFA and the CFTC. We will explain why being a US citizen limits your options significantly, but also offers protections that offshore traders can only dream of. We will teach you how to verify a license number so you can spot a clone firm, a scam website pretending to be a legitimate broker, from a mile away. This is not just about avoiding scams, it is about optimizing performance. We are going to dive deep into the technical infrastructure of these apps. We will talk about execution speed measured in milliseconds. In the world of high-frequency trading and institutional scalping, a delay of half a second is an eternity. If your app lags every time the market moves, you are paying a hidden tax on every single trade. We call this slippage. It is the difference between the price you clicked and the price you actually got filled at. Over a year of trading, negative slippage can eat up 20 to 30% of your potential profits. We are going to show you how to test for this and how to read the fine print in the client agreement to see if your broker has a slippage policy that protects them while hanging you out to dry. Furthermore, we need to talk about data. A trading app is only as good as the data it displays. Many free apps provide delayed data or indicative prices that do not represent the actual tradable market. Imagine trying to navigate a ship using a map that is 5 minutes old. You would crash. We will establish the criteria for assessing data integrity, ensuring that the candles you are analyzing are accurate representations of price action, not smoothed-out approximations designed to save the broker bandwidth costs. We will also cover the integration of news feeds and economic calendars. In Forex, currency pairs react violently to central bank announcements and geopolitical shifts. A professional app puts this information at your fingertips. A predatory app hides it so you get blindsided by a sudden volatility spike. This series is also going to tackle the elephant in the room: customer support. It sounds boring until you have a trade stuck in limbo, or a withdrawal that has been pending for 10 days. We will provide you with a stress test script to use on potential brokers. We will show you how to gauge their responsiveness before you deposit. If they answer in seconds when you want to give them money, but take days to reply when you have a technical issue, that is a red flag we will teach you to spot immediately. Finally, we will address the psychology of the platform itself. Every app has a user experience designed to influence your behavior. Some are cluttered, causing cognitive overload and leading to hesitation. Others are overly simplistic, encouraging overtrading and gambling behavior. We are going to analyze the ergonomics of trading. How easy is it to modify a stop loss in a panic? How clear is your margin usage display? If you are close to a margin call, does the app alert you clearly? Or does it let you drift into a forced liquidation? These are not minor details. They are the safety features of your vehicle. This is a masterclass in due diligence. We are stripping away the marketing jargon, the celebrity endorsements, and the bonus offers to look at the raw machinery of Forex execution. We are doing this because your choice of platform is effectively your first trade. If you go long on a bad broker, you have already lost. If you shortchange your research on the app, you are sabotaging your career before the opening bell even rings. This series is your insurance policy. It is the education that usually costs traders thousands of dollars in losses to learn the hard way. We are giving it to you now step by step so you can bypass the disaster and go straight to the professional setup. Buckle up. We are about to tear down the industry standard and rebuild your expectations from the ground up. We are moving past the hype and into the mechanics of how money actually moves. This is part 1, the foundation. In the next part, we are going to open the hood and look at the most critical, yet most misunderstood aspect of any trading app: regulation and safety of funds. We will explain exactly what happens to your money when you click send, and why the jurisdiction of your broker might matter more than their spread. But for now, understand the gravity of this choice. Your app is your tool, your weapon, and your lifeline in the markets. Do not choose it lightly. Let's begin the deep dive. Imagine waking up tomorrow morning, grabbing your phone to check a trade you left running overnight, and seeing that your profit target was hit. You have just made $5,000. You feel that rush of adrenaline, that validation that your analysis was correct. You navigate to the withdrawal section, request the transfer to your bank account, and wait. 2 days pass. Nothing. 5 days. You send an email to support. It bounces back. You try to log into the website, but the page returns a 404 error. In a cold sweat, you check Twitter and Reddit, and you see hundreds of other traders panic posting about the same thing. The broker has vanished. Your capital, your profits, and your financial data have been vaporized into the digital ether. This sounds like a horror story, but it is a historical reality that has played out dozens of times in the retail Forex industry. This is why the first and most non-negotiable item on your checklist is regulation and the safety of funds. Before we look at spreads, before we look at leverage, and before we look at how pretty the charts are, we have to ensure the entity holding your money actually exists within the legal framework of a reputable jurisdiction. In the world of Forex regulation, not all licenses are created equal. We need to categorize them into tiers, because a license from a top-tier regulator provides a fortress of protection, while a license from a tiny island nation might be worth less than the paper it is printed on. If you are in the United States, your landscape is very specific. You are looking for two acronyms: the CFTC, which is the Commodity Futures Trading Commission, and the NFA, the National Futures Association. The United States has some of the strictest financial regulations on the planet. They enforce these rules to protect you from predatory practices, but this protection comes with restrictions that often frustrate new traders, such as the FIFO rule, first in, first out, and leverage caps of 50-to-1 on major pairs. However, consider the trade-off. The NFA requires brokers to maintain massive capital reserves, often upwards of $20 million, just to open their doors. This proves solvency. If a broker is regulated by the NFA, they are subject to rigorous auditing. They cannot simply take your money and run because they are under constant surveillance by the federal government. If you are a U.S. citizen, using an offshore, unregulated broker to get higher leverage is not just a legal gray area. It is a massive security risk. You have zero recourse if that offshore entity decides to close your account. There is no phone number to call, no office to visit, and no agency to file a complaint with. For our international viewers, or those looking at the global standard, we look at other Tier 1 regulators like the FCA in the United Kingdom or ASIC in Australia. These bodies enforce similar strict standards. One of the most critical mechanisms they enforce, and something you must verify your app has, is segregated client funds. Let's break down what segregated funds actually means with a practical example. Imagine a broker is a restaurant. You give them money to buy ingredients for your meal. If they take your money and put it into the same cash register they used to pay the electricity bill, the staff salaries, and the rent, that is commingling funds. If the restaurant has a bad month and cannot pay the rent, the landlord takes all the money in the register, including the money you gave them for your meal. You are left hungry and broke. In a segregated account structure, the broker must take your deposit and place it into a completely separate bank account, usually with a Tier 1 banking institution, that is distinct from the company's operational funds. Even if the broker goes bankrupt tomorrow, creditors cannot touch your money because legally, it does not belong to the broker. It belongs to you. If an app cannot explicitly prove they segregate funds, you delete that app immediately. Now, we must discuss a feature that saved thousands of traders from financial ruin during the Swiss franc crash of 2015. It is called negative balance protection. To understand why this is vital, we have to look at a case study of a black swan event. On January 15, 2015, the Swiss National Bank unexpectedly removed the cap on the franc's value against the euro. In seconds, the market moved thousands of pips. It was a violent vertical move on the charts. Traders who were long on EURF didn't just hit their stop losses. The market moved so fast that the liquidity evaporated. The price gapped right past their stops. A trader with a $5,000 account didn't just lose their $5,000. Because of leverage, they ended up owing the broker $20,000, $50,000, or even $100,000. People lost their life savings and were chased by debt collectors because of a single news event. Negative balance protection is a policy that guarantees you can never lose more than your initial deposit. If your account goes to negative $50,000, the broker absorbs that loss, not you. In the US, regulations work differently regarding this, but for many global jurisdictions, this is a mandatory safety net. You need to read the client agreement to see if this clause exists. If it doesn't, you are theoretically liable for debts exceeding your capital. So, how do you actually verify this? You do not trust the footer of the website. Scammers are smart. They know you look for licensed by the NFA or authorized by the FCA at the bottom of the page. They will copy and paste legitimate text and even steal license numbers from real brokers. This is known as a clone firm. They set up a website that looks identical to a major bank or broker, use a similar URL, and cite a real license number. Here is your step-by-step forensic process. When you find a broker app you like, scroll to the bottom and find the license number. Copy it. Then, leave the broker's website entirely. Go directly to the regulator's official database, for example, the NFA's basic system or the FCA's register. Paste the number there. The database will return the name of the company that owns that license. Does the name match the app exactly? Check the contact details. Does the URL listed on the government website match the URL in your browser? Clone firms often fail this test. They might use the name Global Forex Trading. but the license number belongs to a company called Global Forex Limited. That slight discrepancy is the smoking gun. Furthermore, look at the status column in these databases. You might find a broker that is technically registered, but the status says pending or exempt. This is not the same as fully regulated. We have seen instances where apps claim to be regulated, but when you dig into the NFA database, they are only registered as a commodity pool operator or an exempt foreign firm, which does not grant you the same protections as a retail foreign exchange dealer, RFED. The nuances here are the difference between a safety net and a concrete floor. You also need to investigate the broker's longevity and track record. We are looking for historical trends of stability. A broker that has been operating since 2005 and survived the 2008 financial crisis and the 2015 Swiss flash crash without becoming insolvent has proven their risk management models work. A brand new app that launched 6 months ago with flashy influencers and zero track record is a black box. They haven't been stress tested by a true market panic yet. Do you want to be their crash test dummy? Finally, consider the jurisdiction of dispute resolution. If you have a conflict with a U.S. broker, you can file for arbitration through the NFA. It is a structured legal process. If you have a dispute with a broker registered in an offshore tax haven, your only option might be to hire a lawyer in that specific island nation, which will likely cost you more than your trading account is worth. The legal infrastructure surrounding the app is just as important as the code the app is written in. By now, you should feel a shift in how you view these icons on your phone. They are not games, they are legal contracts. You have confirmed the regulator is top tier. You have verified the license number on the government database to rule out clones. You have ensured your funds are segregated and that you have negative balance protection. You have built the walls of your fortress. Your capital is safe from theft and bankruptcy. But safety is only the first layer of defense. You can have the safest broker in the world, fully regulated and completely transparent, and they can still bleed you dry, penny by penny, without you ever realizing it. They don't steal your money. They just charge you an invisible tax every time you press the buy button. This is the silent killer of trading careers. In the next part of this masterclass, we are going to expose the complex, often deliberately confusing world of transaction costs. We are going to dissect spreads, commissions, and the hidden overnight swap fees that can turn a winning strategy into a losing one. You think zero commission means free? Think again. We're going to show you where the real cost is hiding. The most expensive word in the English language is free. In the Forex industry, when you see a marketing banner screaming zero commission, you should immediately translate that in your head to hidden costs. Marketing departments love to frame trading apps as benevolent tools provided to you out of the goodness of their hearts. But we need to be strictly logical. Brokers are businesses. They have massive overheads, server costs, and staff salaries. If they aren't charging you an upfront fee to open a trade, they are extracting that money from you in ways that are much harder to track and often much more expensive in the long run. Let's break down the first and most pervasive cost: the spread. You might have noticed that the moment you press the buy button on your app, your profit and loss usually starts in the red. That isn't bad luck. That is the toll booth. The spread is the difference between the bid price, what the market is willing to pay you, and the ask price, what the market demands you pay. Imagine you walk into a currency exchange at the airport. The board says they sell euros for $1.10, but they only buy them back from you for $1.05. That 5-cent gap is the spread. In the digital world of your trading app, this gap is measured in pips, or points in percentage. A standard retail broker might offer you a spread of 1.5 pips on the euro-dollar. This sounds tiny. Who cares about a fraction of a penny, right? Let's run the math on a hypothetical year of trading to see exactly why you should care. Imagine trader A and trader B. They both take the exact same 1,000 trades in a year. They both trade standard lots, which is 100,000 units of currency. A 1-pip movement on a standard lot is worth roughly $10. Trader A uses a popular, free app with a spread of 2 pips. Every time he opens a trade, he pays $20. Over 1,000 trades, he has paid $20,000 in transaction costs. Trader B did her homework. She chose a broker with a raw spread of 0.1 pips and a commission of $7 per round turn. Her total cost per trade is roughly $8. Over the same 1,000 trades, she pays $8,000. The difference is $12,000. That is $12,000 of pure profit that trader A lost, simply because he downloaded the wrong app. He didn't make bad trading decisions. He made a bad infrastructure decision. When you are choosing an app, you must look for a specification or contract details tab. If the standard spread on major pairs like Eurist or GPUST is consistently above 1.5 pips during normal liquid hours, you are looking at a ripoff. You are effectively running a race wearing lead boots. However, spreads are not static. This is where the variable spread trap catches beginners. Most apps use variable spreads, meaning the gap widens when volatility hits. Let's visualize a scenario. It's 8:30 a.m. in New York. The non-farm payroll numbers are about to drop. The market is nervous. Liquidity providers pull their orders. Suddenly, that tight 1 pip spread explodes to 10 or even 20 pips. Here is the nightmare scenario. You have a long position open with the stop loss 10 pips below the current price. The news hasn't even released yet. The price hasn't actually moved down. But because the spread widened, the bid price drops to hit your stop loss. You are kicked out of the trade with a loss. Then the news releases and the price shoots up in your direction. You correctly predicted the move, but you lost money because the app spread mechanics forced a liquidation. When vetting an app, you need to look at user reviews and forums specifically searching for spread widening complaints. Some brokers are notorious for artificially widening spreads to hunt stop losses, while others maintain tight spreads even during chaos. Now let's move to the silent killer of swing traders, the swap fee or rollover. If the spread is the cost to enter the club, the swap is the cost to stay overnight. Forex is traded in pairs. When you buy the AUD, you are buying the Australian dollar and selling the US dollar. You are effectively depositing Australian dollars and borrowing US dollars. In the real world, when you deposit money, you earn interest. When you borrow money, you pay interest. The swap fee is the difference between the interest rates of the two countries. If the currency you are buying has a higher interest rate than the currency you are selling, you might actually get paid to hold the trade. This is called a positive swap. But in the current economic climate, or depending on the broker's markup, you are often paying a negative swap. Let's look at a hypothetical case study of a swing trader who holds a position for 3 weeks. They are shorting a pair with a high negative swap. Every single night at 5 p.m. New York time, the server rolls over, and a fee is deducted from their account equity. It might be $5 a night, but then comes Wednesday. In the Forex market, spot trades settle in 2 days T+2. Therefore, on Wednesday, the market accounts for the weekend. This is the dreaded triple swap Wednesday. On Wednesday night, you are charged 3 times the daily rate. By the end of 3 weeks, this trader might be up 50 pips in price action, which should be a $500 profit. But they have accumulated 3 weeks of daily negative swaps plus 3 triple swap Wednesdays. They check their balance and realize half their profit has been eaten by overnight financing fees. Many user-friendly apps hide these swap rates deep in the settings menus because they know beginners ignore them. A professional checklist requires you to open the app, navigate to the instrument properties, and look for swap long and swap short. If the broker marks up these rates aggressively, meaning they charge you way more than the interbank rate warrants, it is a sign they are profiting from your patience. We also need to discuss the account types, standard versus raw or ECN. A standard account usually has 0 commission but marked up spreads. A raw or ECN account has raw market spreads, sometimes 0, but charges a flat commission per lot. Here is the truth the industry keeps quiet. If you are a serious trader, you almost always want the commission-based account. Why? Because commissions are fixed. You know exactly what you are paying, usually between $5 to $7 per lot. Spreads are variable and opaque. By choosing a 0 commission standard account, you are trading certainty for uncertainty. You are letting the broker hide their fee inside the price feed, making it impossible for you to calculate your true break-even point accurately. Transparency is the hallmark of a professional environment. Finally, check the fine print for inactivity fees and withdrawal fees. There are apps that will charge you a monthly penalty just for taking a break from trading. Imagine being punished for going on vacation or stepping back to refine your strategy. This is a predatory practice designed to force you to overtrade. Similarly, if an app charges you a percentage to withdraw your own money, that is a massive red flag. Flat fees for bank wires are normal. Percentage fees on withdrawals are a tax on your success. So add this to your checklist. 1. Check the average spread on major pairs. Is it competitive? 2. Verify if they offer raw/ECN pricing structures versus standard markups. 3. Inspect the swap rates. Are they punishing you for holding positions? 4. Check for triple swap rules and hidden inactivity fees. You have now verified the safety of your funds and you have analyzed the cost of doing business. You know your broker isn't stealing your money, and you know they aren't bleeding you dry with fees. But there is a third component that is even more critical than cost. You can have the cheapest broker in the world, but if you click buy, and the trade doesn't execute instantly, or if it executes at a worse price than what you saw on the screen, you are dead in the water. We are entering the realm of milliseconds. In the next part, we are going to tear apart the technological infrastructure of these apps. We are going to explain slippage, requotes, and latency. We will show you how to spot if a broker is using a virtual dealer plugin to intentionally delay your orders and make you lose. Speed isn't just a luxury. It's the difference between a winning month and a blown account. Keep watching. The virtual dealer plugin. It sounds like a piece of futuristic tech, but in the dark corners of the retail Forex industry, it is a weapon used against you. This is a piece of software installed on the broker's server that intentionally delays your order execution. Imagine you are playing an online competitive shooter game. You see the enemy, you aim perfectly, and you pull the trigger. But the game waits 3 seconds before registering your shot. By then the enemy has moved and you are dead. That is exactly what a virtual dealer plugin does to your capital. It holds your order for a split second, checks if the market price has moved in your favor or against you, and then decides whether to fill you or slip you. If the price moves in a way that would make you money, the plugin slips you to a worse price. If the price moves against you, it fills you immediately to lock in that loss. This is the invisible barrier that separates the winners from the losers, and it brings us to the most technical, yet crucial part of your checklist: execution quality. When you tap buy on your phone screen, you are initiating a complex digital relay race. The signal goes from your phone to the nearest cell tower through fiber optic cables across the ocean to the broker's server, then to a liquidity provider like a major bank, and then the confirmation has to travel all the way back to you. This journey takes time. In a fair environment, this takes milliseconds. In a manipulated environment, it takes seconds. Let's talk about latency. Latency is the time delay between your action and the result. You need to test this. When you are vetting a new app, do not just look at the charts. Open a demo account and a small live account simultaneously. Place a trade on both at the exact same time. Record your screen. If the demo account executes instantly but the live account spins for 3 seconds before confirming, you are dealing with artificial latency. The broker is likely running a B-book model where they are taking the other side of your trade, and their algorithm is calculating if they want to accept the risk before letting you in. This leads us directly to slippage. Slippage occurs when the price you requested is different from the price you received. There is natural slippage, and there is malicious slippage. Natural slippage happens in legitimate markets. If the non-farm payrolls report is released and the news is shocking, the price might jump from 1.0500 to 1.0550 in a single tick. There physically was no liquidity at the prices in between. If you tried to buy, you get filled at the next available price. That is fair, that is the market. However, malicious slippage is asymmetrical. This is the smoking gun you need to look for in your trading journal. Over a sample size of 50 or 100 trades, look at your entry prices. If you experience negative slippage, meaning you get a worse price than you clicked 70% of the time, but you never ever get positive slippage, where you get a better price than you clicked, you are being cheated. In a true ECN, electronic communication network, environment, you should occasionally get filled at a better price if liquidity is available. If the slippage only ever hurts you and never helps you, the deck is stacked. Now, consider the nightmare of the requote. This is an artifact of instant execution protocols. Some apps ask you, do you want to buy at 1.1000? You click yes. The market moves to 1.1001. The app rejects your trade and offers you a new price. Price changed. Do you want to buy at 1.1001? You click yes. It moves again. Price changed. This usually happens when the market is moving fast, exactly when you want to enter to catch momentum. This effectively blocks you from profitable trades while allowing you to enter stagnant, losing ones. To avoid this, your checklist must prioritize apps that offer market execution. With market execution, you are telling the broker, get me in right now at the best available price no matter what. You will never get a requote. You might get slippage, but you will get into the trade. Professional traders almost exclusively use market execution because in a high-stakes environment, being left behind is worse than paying a fraction of a pip in slippage. We also need to scrutinize the depth of market, or DOM. Most basic trading apps just show you a buy price and a sell price. This is level 1 data. It is like trying to drive a car while looking through a keyhole. A professional-grade app will offer you level 2 data or a DOM ladder. This shows you the available volume at different price levels. Shows you liquidity. Why does this matter? Imagine you want to buy 5 standard lots. That is 500,000 units of currency. If the app only shows the top of the book, you assume you can buy all 5 lots at that price. But maybe there is only 1 lot available at that price. The other 4 lots will be filled at the next price up and the next and the next. This is called eating through the book. Without seeing the depth of market, you are blind to the liquidity risks. If an app claims to be for serious traders but doesn't offer any visibility into order volume, they are treating you like a gambler, not a market participant. Furthermore, we have to discuss the stability of the server during high-impact events. This is the stress test phase of your checklist. Do not trust an app based on how it performs on a Tuesday afternoon when nothing is happening. You need to see how it performs during the release of the US CPI, Consumer Price Index, or an interest rate decision by the Federal Reserve. Here is a case study scenario. The market is calm. You have a stop loss set to protect your account. Suddenly news breaks. The market dives. Legitimate apps might struggle for a split second due to volume, but a predatory app might freeze. The quotes stop moving. The charts stop ticking. You try to close your position, but the button is grayed out or unresponsive. 5 minutes later, the app wakes up, and your account is blown because your stop loss wasn't triggered during the server freeze. This is often blamed on technical difficulties, but coincidentally, these difficulties always seem to happen when the broker stands to lose money. Check user forums for reports of server freezes or unable to close trades during news. If you see a pattern of complaints centered around specific dates of high volatility, that is not a tech issue, that is a business model. You must also evaluate the types of orders available. A basic app gives you buy, sell, and close. A professional app gives you buy limit, sell limit, buy stop, sell stop, stop loss, and take profit. But the elite apps, the ones you should be aiming for, give you advanced order management. Look for OSO orders, one cancels the other. This allows you to set a buy stop above the price and a sell stop below the price simultaneously. If the market breaks out in either direction, one order triggers and the other is automatically deleted. This is essential for news trading strategies. Without it, you have to manually cancel the unfilled order. And in a fast market, you might forget, leaving you exposed to an unintended trade. Look for trailing stops that reside on the server, not on your phone. This is a critical technical distinction. If you set a trailing stop, which follows the price as it moves in your favor to lock in profit, does that logic live on your device or on the broker's cloud? If it lives on your phone client side, and your phone loses internet connection or runs out of battery, the stop stops trailing. Your protection is gone. If it lives on the server side, you can throw your phone in a lake, and the broker's computer will still manage your risk. Always verify if the app supports server-side trailing stops. By this point in the checklist, you are filtering out 90% of the apps on the store. You have rejected the ones with no regulation. You have rejected the ones with hidden costs. You have rejected the ones with slow, manipulative execution. You are left with a short list of robust, transparent platforms. But here is the irony. You can have the fastest, cheapest, safest execution engine in the world, but if the dashboard, the windshield you look through, is distorted, you will still crash. We are talking about the charts, the visual representation of price. You rely on these candlesticks to make decisions. But what if I told you that the candles you see on your screen might not be the real market data? What if the broker is smoothing out the wicks, hiding the gaps, or painting a picture that looks cleaner than reality, just to lull you into a false sense of security? In the next part, we are going to dissect the charting and analysis capabilities. We will explain why indicative prices are useless, why you need to check for Sunday candles, and how to spot if your broker is manipulating the visual history of the market to hide their own execution failures. The chart is your map, and we are about to verify if it's actually accurate. In the high-stakes environment of Forex trading, your chart is your primary source of truth. It is the windshield through which you view the road ahead. But what if I told you that for many retail traders, that windshield is intentionally fogged? What if the map you are using to navigate a trillion-dollar market has been subtly altered to hide the cliff edge? This brings us to the most insidious form of psychological warfare in the trading industry: data manipulation and charting integrity. You need to understand a fundamental reality. The line you see moving on your screen is often an optical illusion. Most standard trading apps default to showing you the bid price. This is the price at which you can sell. However, when you want to buy, you must pay the ask price, which is always higher. The gap between them is the spread, which we discussed earlier. But here is where the illusion destroys accounts. Imagine a specific scenario. You have a short position on the pust. You have placed your stop loss at 1.2500. You are watching the chart like a hawk. The price candles tick up. 1.2490, 1.2495, 1.2498, and then it drops back down to 1.2450. You breathe a sigh of relief. According to the chart on your screen, the price never touched your line. You should still be in the trade making a profit. But then you look at your balance. The trade is gone. You were stopped out. You feel cheated. You feel like the broker hunted you. You check the chart again. The highest point of the candle is clearly 1.2498. This is the bid price blindness. Because the chart only drew the bid price, it showed the high as 1.2498. But the ask price, the price you pay to close a short position, was likely 2 or 3 pips higher, sitting at 1.2501. The chart didn't show it, but the market executed it. This is not a glitch. It is a default setting designed to confuse you. A professional-grade app must allow you to enable the ask line overlay. This is a mandatory item on your checklist. You need to see both lines on the screen simultaneously. If an app does not give you the option to visualize the ask price, they are forcing you to trade with one eye closed, guaranteeing that you will be blindsided by spread fluctuations. Now let's go deeper into the mathematics of the chart itself. We need to talk about the Sunday candle phenomenon. This is a technical nuance that ruins the strategies of thousands of algorithmic and technical traders without them ever realizing why. The Forex market never truly sleeps, but the banking week is 5 days. However, depending on the time zone of your broker's server, the start of the week varies. If your broker's server is set to a time zone like GMT+0, the market opens late Sunday night their time. The charting software interprets this few hours of trading as a distinct daily candle. Why does this matter? Imagine you are using a 50-day moving average or an RSI, Relative Strength Index, indicator. These tools rely on mathematical formulas based on the number of closed prices. If your chart has 6 candles per week, 5 full days plus a tiny Sunday stub, instead of 5, your indicators are calculating data based on a completely different dataset than the rest of the professional world. Your 50-day moving average will be flatter. Your RSI signals will be delayed. You are effectively using a ruler that is a different length than the institutional traders you are trying to mimic. Case studies of automated trading systems show that strategies that work perfectly on a New York close chart, which eliminates the Sunday candle, often fail miserably on a broker with Sunday candles. The noise of that low-volume Sunday session distorts the mathematical trend. When choosing an app, you must verify their server time alignment. You want a broker that operates on New York close charts, typically GMT+2 or GMT+3 depending on daylight savings, to ensure your daily candles align perfectly with the global banking session, eliminating the Sunday phantom and synchronizing your analysis with the big banks. Furthermore, we must address data smoothing. Brokers pay for data feeds. High-quality, tick-by-tick data from top-tier providers like Bloomberg or Reuters is expensive. Some brokers cut costs by using filtered data feeds that smooth out the price action. They might take an average of prices every second rather than showing every single tick. On a clean, smooth chart, a trend looks beautiful and linear. It gives you false confidence. In reality, the market was jagged, violent, and erratic. By smoothing the data, the broker is hiding the risk. You might look at a historical chart and think, wow, that trend was so easy to trade, I would have held on. But if you had seen the real-time volatility, the jagged spikes that would have shaken you out emotionally, you would see a different picture. You need an app that provides raw data. You want to see the ugliness. You want to see the bad ticks, because those ticks represent liquidity gaps. If a chart looks too perfect, be suspicious. This leads to the concept of repainting in history. A dishonest broker has the power to retroactively edit the data on their server. Suppose there was a massive price spike that triggered thousands of stop losses, causing client complaints. A shady broker might clean that spike from the historical chart a day later. If you go back to review your trade, the chart shows the price never went there. You have the loss in your account, but the evidence on the chart has been scrubbed. This is gaslighting at a financial level. To protect yourself, you must use a third-party charting platform to cross-reference prices. Never rely solely on the broker's own app for your historical analysis. Use a neutral global data provider like TradingView or a similar independent platform. Check the candles. Did the broker's app show a spike that the global market didn't? Or did the global market show a spike that the broker's app deleted? Any discrepancy here is evidence of a desk feed that is being manipulated to suit the house's needs. Finally, let's look at the tooling within the app. A chart is useless if you cannot interact with it. We are not talking about having 100 fancy indicators that just clutter your screen. We are talking about precision drawing tools. Can you draw a trend line that snaps to the wick of the candle magnetically? If you are trying to draw a support level on a mobile screen with your finger, and the line is floating vaguely near the price, your precision is zero. You need magnet mode. Does the app support multi-time frame analysis on a single screen? Professional analysis requires seeing the forest and the trees. You need to see the weekly trend to know the direction, and the 15-minute chart to time your entry. Most basic apps force you to switch back and forth, reloading the chart each time. By the time you switch back, you've lost context. Top-tier apps allow for split-screen viewing or rapid toggling that preserves your drawings across time frames. If you draw a key resistance level on the daily chart, it must appear on the 1-hour chart automatically. If the app treats every time frame as a separate universe, it is hindering your ability to perform top-down analysis. Your checklist for charting is now rigorous. Ask price overlay. Can you see the buy price visually? New York close candles. Does the server time eliminate the Sunday data distortion? Raw data feeds. Is the price action authentic and unsmooth it? Cross-reference capability. Do the candles match independent third-party data? Syncing drawings. Do your technical levels persist across different time frames? If an app fails these tests, it is not a trading tool. It is a slot machine with a fancy screen. You are basing financial decisions on compromised data. But let's assume you have found an app with pristine charts, fair execution, and regulatory safety. You are staring at the screen and you see the perfect technical setup. The candles are aligning. The support is holding. You are ready to buy. Suddenly, the candle drops 50 pips in 1 second. There was no technical reason for it. The support level didn't matter. The trend line didn't matter. You just lost money and you have no idea why. This happens because charts only tell you what is happening, not why it is happening. The why comes from the outside world. It comes from central banks, geopolitical conflicts, and economic data releases. Most traders ignore this until it hits them in the face. In the next part of this masterclass, we are going to look at the features that connect your app to the real world, the news feed and the economic calendar. We will explain why a breaking news notification that arrives 3 minutes late is useless, and how to tell if your app's newsfeed is designed to inform you or distract you. We are going to teach you how to filter the noise and trade the news before the rest of the retail market even knows what happened. Imagine you are a soldier on a battlefield. You have the best rifle money can buy, your aim is perfect, and your training is elite. But you are blindfolded. You can hear the explosions, you can feel the ground shaking, but you have no idea where the enemy is coming from or why they are attacking. This is exactly what it is like to trade with a pristine chart, but a delayed or inferior news feed. You see the price crashing, the explosion, but you don't know if it's a temporary skirmish or the start of a world war. In part 6 of this masterclass, we are integrating the outside world into your trading station. We are talking about the economic calendar and real-time news integration. Most beginner traders treat the news as an afterthought. They check a website in the morning and then forget about it. This is a fatal error. The Forex market is driven by macroeconomics. It is a continuous pricing mechanism of the health of nations. When the US Federal Reserve speaks, the world listens and the charts move. If your app delivers that speech to you 3 minutes after it happened, you are not a participant. You are a casualty. Let's start with the concept of information latency. In the institutional world, banks pay tens of thousands of dollars a month for Bloomberg terminals or Reuters icon. Why? Because they need the data in microseconds. When the consumer price index, the inflation data, hits the wire, algorithms scan the headline, interpret the number, and execute billions of dollars in trades within milliseconds. Now look at your free trading app. A notification pops up. US inflation higher than expected. You tap it. You read it. You look at the chart. By the time you do this, 5 minutes have passed since the release. The initial move, the alpha, is gone. The market has already repriced. If you enter now, you are likely buying at the top of a spike, right before the profit-taking begins. You are providing exit liquidity for the professionals who got the news instantly. Therefore, your checklist must include a live, Auto-updating economic calendar. This seems basic, but the devil is in the details. Open the calendar section of your potential app. Look at an upcoming event. Does it have a countdown timer ticking down to the second? Or just a static time like 8:30 a.m.? You need the countdown. Trading is about timing. You need to know exactly when to pull your hands away from the keyboard. Furthermore, does the calendar update automatically upon release? Test this. Watch a minor news event release live. Do the numbers, the actual versus forecast, populate instantly on the screen? Or do you have to manually refresh the page? If you have to pull to refresh, delete the app. In a fast market, that 3-second refresh delay is an eternity. You need push technology that forces the data to your screen the moment the server receives it. We also need to discuss news markers on charts. This is a feature found in top-tier applications that visualizes the why. Imagine looking at a chart and seeing a massive red candle from 3 days ago. Without context, you might think it was a technical breakdown. But a professional app will have a small icon, maybe a flag or a loudspeaker symbol, anchored to the bottom of that specific candle. When you click it, it tells you, ECB interest rate decision. Now you know. That wasn't technical, that was fundamental. This feature allows you to backtest effectively. You can look back and see how specific pairs react to specific news events without leaving the chart interface. It bridges the gap between technicals and fundamentals seamlessly. Let's look at a case study. The non-farm payrolls, or NFP. This is the Super Bowl of Forex data. Released on the first Friday of every month. Volatility is guaranteed. A bad app will often freeze or lag during the release because their data feed cannot handle the surge in volume. But a good app does something more important than just staying online. It filters the noise. During NFP, dozens of headlines hit the wire simultaneously. Unemployment rate, average hourly earnings, participation rate, and the headline job number. A novice trader gets overwhelmed. Which number matters? A superior trading app prioritizes the data. It highlights the high-impact deviation. If the forecast was 200K jobs and the result is 300K, the app should flash this in bright green, instantly signaling a strong deviation. Does the math for you. It categorizes the news, so you don't have to be an economist to understand the immediate sentiment. This leads us to Squawk services. This is a feature rarely found in free apps, but standard in professional mobile platforms. A squawk is a live audio feed. Instead of reading headlines, you listen to them. A voice commentator at a news desk in London or New York announces the data as it hits the wire. US GDP comes in at 2.5%, beating expectations. Why is audio superior? Because it frees your eyes. If you are reading a notification, you aren't looking at the price action. If you are listening to the squawk, your eyes can stay glued to the candles, watching for the reaction while your ears process the cause. It creates a multisensory trading environment that dramatically improves your reaction speed. If you find an app that integrates a live audio squawk for major events, that is a massive green flag. It shows the broker understands the needs of active traders. However, there is a dark side to news feeds: the content farm distraction. Many brokers fill their news sections with low-quality, clickbait articles generated by AI or outsourced freelancers. Headlines like, "Is Bitcoin going to 1 million?" or "Why gold will crash tomorrow" are not news. They are opinion pieces designed to trigger emotional trading. They want you to feel fear of missing out, FOMO. They want you to click buy on an impulse. Your checklist involves an audit of the news source. Look at the News tab. Who is the provider? Is it a reputable financial wire like Dow Jones, FX Wire Pro? Or a direct feed from an exchange? Or is it broker name analytics team? If the news is purely in-house opinion pieces, be very careful. In-house analysis is often biased or simply incorrectly timed. You want raw facts, not narratives. You want the data, not the story. The story is what you tell yourself after you lose money. The data is what helps you manage risk. Let's imagine a safe haven scenario to illustrate the importance of push notifications. It is 2 p.m. on a Sunday. The markets are closed. Suddenly, a major geopolitical conflict escalates. Gold and the Swiss franc are going to gap up massively at the Monday open. A standard app stays silent. You wake up Monday morning to find your account in deep drawdown because the market gapped past your stop loss. A professional app has emergency volatility alerts. Even when the market is closed, if a major global event occurs that will impact opening prices, the app sends a push notification. High risk warning. Geopolitical event detected. Expect market gaps. This warning allows you to prepare. You can adjust your mindset, deposit funds to support margin, or plan your exit strategy before the bell rings. It is proactive, not reactive. Finally, check for the filter function. An economic calendar without a filter is a wall of text. There are hundreds of low-impact data releases every week. Spanish manufacturing data, Italian retail sales, that usually don't move the needle. You need to be able to filter by high impact only, or by specific currencies. If you only trade US dollar to Japanese yen, you do not want your phone buzzing about the Canadian housing market. A cluttered feed leads to alert fatigue. You stop paying attention because there are too many notifications, and that is when you miss the one that actually matters. So, here is the recap for the information section of your checklist. Countdown timer. Does the calendar tick down to the second? Auto update. Do the numbers populate instantly without refreshing? News markers. Can you see past events visually on the chart? Audio squawk. Is there an option to listen to live breaking news? Source quality. Is the feed from a major wire service or a content farm? Smart filtering. Can you mute the noise and focus on your specific pairs? You have now secured your connection to the global economy. You have a broker that is regulated, cheap, fast, honest with their charts, and keeps you informed in real time. You are building a professional setup. But there is a physical limitation we haven't discussed yet. You are doing all of this, analyzing charts, reading news, managing risk on a screen that is 6 inches wide. You are using your thumbs, not a mouse. The margin for error is physically massive. One slip, one accidental tap, and you could accidentally open a position size 10 times larger than you intended. This is called the fat finger error, and it has wiped out more accounts than any market crash. In the next part, we are going to conduct a forensic audit of the user interface, UX, and usability. We are going to look at safety locks, one-click trading safeguards, and the ergonomic design flaws that brokers use to trick you into making mistakes. We will show you how to set up your interface so that it is physically impossible to make a catastrophic error. Your thumbs are about to become your biggest liability, unless you configure the app correctly. You are holding a device that was designed to scroll through social media, play casual games, and send text messages. It was not natively designed to manage leveraged financial risk. When you shrink a professional trading desk, which usually consists of 4 monitors, a specialized keyboard, and a mouse with adjustable DPI, down to a 6-inch touchscreen, you are introducing a massive physical hazard. We call this the fat finger risk, but that term is too cute for the damage it causes. A more accurate term is ergonomic financial suicide. Part 7 of our masterclass is a forensic audit of the user interface and usability. We are not looking for pretty design. We are looking for safety design. We are looking for friction. In most software, friction is bad. You want things to be easy. In Forex trading, friction is often the only thing standing between you and a blown account. Let's start with the most dangerous setting in any trading app, the default lot size memory. Imagine this scenario. You normally trade 0.10 lots, a mini lot. You place a trade. You close it. You see another opportunity and rush to open the ticket. But the app has reset the default volume to 1.00 standard lot. In your haste, you don't notice the missing decimal point. You click buy. The market moves 10 pips against you. On your normal size, you would be down $10, a manageable scratch. But because the app reset the volume to a standard lot, you are down $100 in seconds. If you have a small account, you might be down 10% of your equity instantly. This is not a user error. This is a design failure. A professional checklist requires you to test the memory of the order ticket. Open a demo trade with a specific, non-standard lot size like 0.13. Close the ticket. Open a new ticket. Does the volume field still say 0.13? Or did it revert to 1.00? Or does it revert to the last used size? The safest apps allow you to hard lock a default lot size in the settings. If your risk management plan says you only trade 0.5 lots, you want the app to populate 0.5 lots every single time without exception. If the app forces you to manually scroll or type the lot size every time you open the window, it is introducing a fatigue point where errors will eventually happen. Next, we must discuss the one-click trading paradox. Marketing teams love to tout one-click trading as a feature for serious scalpers. And yes, if you are a professional scalper with years of experience, speed is key. But for 99% of traders, one-click trading is a trap. It removes the confirmation step. It removes the "are you sure?" barrier. Consider the ergonomics of holding a phone. Your thumb hovers naturally over the bottom right or bottom center of the screen. Predatory apps often place the buy button exactly where your thumb naturally rests while scrolling. One accidental tap, perhaps while you are just trying to inspect the chart or zoom in, and you are in a trade. There is no undo button in the financial markets. You are now paying the spread immediately. To get out, you have to sell, paying the spread again. You have lost money simply because you touched your screen. Your checklist must prioritize apps that offer a double tap to execute or a swipe to confirm feature. These are safety mechanisms borrowed from critical systems like nuclear launch protocols or heavy machinery controls. A swipe requires a deliberate, conscious motor function. It is almost impossible to accidentally swipe a specific slider from left to right. A tap is accidental. A swipe is intentional. If you are a beginner, disable one-click trading immediately. If the app does not allow you to disable it, that app is dangerous. We also need to analyze the proximity risk of the buttons. Open the trade management screen. Look at the close position button. Now look at the add to position or double up button. Are they right next to each other? Are they the same color? This is a classic dark pattern in UX design. Imagine you are in a losing trade. You are panicked. You want to cut the loss. You aim for the close button, but your finger hits the button millimeters to the right, which is double up. Instead of exiting the risk, you just doubled your exposure to a losing trade. By the time you realize what happened and close both positions, your loss is catastrophic. A professional app separates these functions. The close button should be isolated, perhaps at the bottom of the screen, distinct from the modify or add buttons. It should be red. It should be obvious. If the interface is a clutter of identical gray buttons, the designer does not trade, or worse, they want you to fail. Furthermore, we need to look at information density versus cognitive load. When you are about to place a trade, what information is presented to you? A bad app shows you the lot size and the price. That's it. A professional app calculates the risk in currency dynamically. This is a critical feature for risk management. As you adjust your stop-loss level on the order ticket, the app should display exactly how much money you will lose if that stop is hit. It should say, stop loss at 1.0500 equals minus $50.00 risk. This translates abstract numbers, pips, into concrete reality, dollars. It forces you to acknowledge the financial consequence before you pull the trigger. If you have to do mental math, converting pips to dollars while the market is moving, you will make mistakes. You will underestimate the risk. Look for apps that have dynamic risk calculators built directly into the order entry screen. This is the hallmark of a platform built for trader longevity. Let's talk about the chart trading interface. Many modern apps allow you to drag and drop stop loss and take profit levels directly on the chart. This is a fantastic feature, but it needs to be precise. Test the sensitivity. When you try to drag the line, does it snap to the exact pip, or does it float? More importantly, is the line thick or thin? I have seen apps where the trade lines are so thick they cover 5 pips of price action on a mobile screen. You can't see the candles behind your own order lines. You are blinding yourself with your own interface. You need an app that uses fine, crisp lines that do not obscure the price action. Additionally, when you drag that line, does a magnifying glass bubble pop up to show you the exact price you are hovering over? Your finger covers the screen. You can't see what is under your finger. The magnifying glass solves this. If the app lacks this, you are guessing where you are placing your stop. Now, consider the P&L flashing psychology. Open a trade and watch the profit and loss number. Does it flash bright green every time it ticks up and bright red every time it ticks down? This is a casino mechanic. It is designed to stimulate your dopamine receptors. It induces anxiety and excitement. It makes you want to close winners too early, to lock in the green, and let losers run to avoid the red. Serious trading platforms often allow you to neutralize the interface. They let you set the P&L display to a static color, like white or gray, or even hide the P&L entirely so you focus on pips or the chart structure. If the app looks like a slot machine with flashing lights and celebratory animations when you win, you need to run. You are in a gamified environment, not a professional workspace. Finally, check the watchlist customization. A chaotic watchlist leads to symbol confusion. This happens when you have EURIST and EURGBP right next to each other. In a rush, you see Euro and click the wrong one. They move differently. One might be trending up, the other ranging. A good app allows you to create multiple custom watch lists. You should be able to separate majors, minors, and exotics. You should be able to add spacers or headers. But the ultimate test of an app's interface is the panic test. This is an imagined scenario you must run through. Imagine you are short the USD/JPY. Suddenly news breaks, the Bank of Japan intervenes. The price spikes 200 pips against you in seconds. You need to close the trade now. Count the clicks. Wake phone. Open app. Biometric login, Face ID. Navigate to Portfolio tab. Find the specific trade scrolling past others. Tap the trade. Tap Close. Confirm close. If this process takes more than 5 seconds or requires more than 3 taps once the app is open, the interface is too slow for crisis management. Professional apps often have a close all button or a streamlined emergency exit workflow. Count the clicks. In a crash, every click costs you money. You have now verified that the app is not actively trying to sabotage your physical execution. You have safety locks, clear buttons, and risk calculators. The car handles well. But even the best car in the world is useless if you call for a tow truck and nobody answers. Technology fails. Servers crash. Liquidity dries up. And when that happens, you are alone in the dark with your money on the line. You need a human. But not just any human. You need a competent professional who has the power to fix your problem instantly. In the next part, we are going to stress test the customer support systems. We aren't talking about polite emails. We are talking about what happens when you need a solution in real time. We will show you how to distinguish between a support bot that gives you generic answers and a trade desk that can save your account from disaster. Imagine you are in a trade. It is a significant position, perhaps 20% of your account is committed. You are short the euro against the dollar. Suddenly the screen goes blank. Your app crashes. You restart it. It spins. Crashes again. You switch to Wi-Fi. Nothing. You switch to data. Nothing. It is not your phone, it is their server. The entire platform is down. In the background on the television you hear breaking news. The Federal Reserve has just made a surprise announcement. The market is moving violently. You are blind, you are exposed, and you are trapped. At this exact moment, the fancy charts, the low spreads, and the regulatory licenses do not matter. The only thing that matters is whether you can pick up a phone, call a number, and have a human being manually close your trade before your account is liquidated. This is the difference between a tech company and a brokerage. And this is why Part 8 of our masterclass is dedicated to the stress test of customer support and crisis management. Most beginner traders test customer support by asking, "What is the minimum deposit?" This is a useless test. It is a sales question. Of course they will answer quickly, they want your money. To truly vet a broker, you need to simulate a crisis before you ever deposit a dime. You need to determine if their support team is a room full of sales agents or a desk of licensed dealers. We need to distinguish between customer service and a dealing desk. Customer service resets your password. They explain how to upload your ID. They are administrative. A dealing desk, however, has access to the liquidity pool. They have the authority to execute trades on your behalf when the front-end software fails. This is a critical fail-safe. Your checklist item number 1 in this section. Does the app list a phone number? I don't mean a WhatsApp number or a Telegram bot. I mean a landline connected to their headquarters. If an app only offers in-app chat or email support, you are taking on massive operational risk. In a server outage, the chat feature usually goes down too because it is hosted on the same infrastructure. A phone line is a separate analog lifeline. You must call this number. Do it during peak market hours, 8 a.m. to 11 a.m. New York time. See who answers. Is it an automated menu that loops forever? Do you sit on hold for 40 minutes? Or does a human answer within 3 rings? When they answer, ask them a technical question. Ask them, if I cannot access the app during high volatility, do you offer voice execution to close positions? If the answer is no, all trading must be done through the app. Hang up and delete that app. They have just admitted that if their technology fails, you are the one who pays for it. A professional broker will say, "Yes, we can take orders over the phone after verifying your security questions." That yes is your insurance policy. Now let's talk about the chatbot masquerading as a human. Artificial intelligence is everywhere, and brokers use it to cut costs. They will have a chat window with a picture of a smiling person named Sarah. You type a question. Sarah replies instantly. Feels efficient. But try asking Sarah, A complex question about swap rates or dividend adjustments on an index CFD. If the reply is a generic link to an FAQ page, you are talking to a bot. If the reply is, "Please wait while I transfer you to a specialist," you are talking to a Tier 1 support agent who knows nothing about trading. You want to find the broker where the first person you talk to understands the mechanics of the market. Here is a specific Turing test for your broker. Go to the live chat and ask this exact question. Can you explain how your margin call policy handles a gap opening on Sunday? Do you liquidate at the Friday close price or the Sunday open price? This is a technical, high-stakes question. A bot cannot answer this. A low-level support agent will be confused. A professional trade desk support agent will give you a precise answer regarding negative balance protection and execution policy. Their ability to answer this question tells you if they are trained to help traders or just trained to onboard customers. We must also discuss the sales versus support culture. There is a predatory practice in the industry known as churn and burn. You can spot this immediately through your interactions with support. If you ask a technical question about the platform, and the agent pivots the conversation to, "How much are you planning to deposit?" or "We have a 20% bonus if you fund today," that is a red flag. This indicates that their internal KPIs, key performance indicators, are based on sales, not retention. They are incentivized to get your money in, not to keep your trading operation running smoothly. A professional broker support team should be neutral. They should be technical support, not account executives. If you feel pressured to deposit during a support query, you are the product, not the client. Consider the language barrier and scripting issue. Trading is a global business, and many brokers outsource support to call centers in low-cost jurisdictions. There is nothing inherently wrong with this, provided the training is elite. However, often it is not. If you are in a panic because of a technical error, and the person on the other end is reading from a rigid script and cannot deviate to understand your specific nuanced problem, you will lose money. You need to test this empathy and flexibility. Create a fake problem. Tell them, "I think there is a glitch in your demo feed, the price of gold is stuck." Even if it isn't, watch how they react. Do they investigate? Do they check their server status? Or do they just say, "Please clear your cache and restart"? The clear cache response is the lazy support agent's way of dismissing you. It shows they are not interested in solving the problem, they just want to close the ticket. Furthermore, look for the service level agreement, or SLA, for withdrawals and disputes. Disputes happen. You might get filled at a price that clearly wasn't on the chart. You need to file a trade inquiry. How does the app handle this? Is there a formal form in the client portal? I have seen apps where the only way to dispute a trade is to send an email to a generic support address. These emails often go into a black hole. You want a broker that has a ticketing system where you can track the status of your complaint, see who is handling it, and receive a formal resolution letter. This paper trail is vital if you ever need to go to the regulator. If they don't have a transparent dispute process, it means they don't expect to resolve disputes in your favor. Let's analyze the 24/5 versus 24/7 myth. The Forex market is open 24 hours a day, 5 days a week. But crypto, which many of these apps also offer, is 24/7. Does the support match the asset class? If an app lets you trade Bitcoin on a Saturday, but their support team is closed until Monday morning, that is a massive liability. Imagine a crypto flash crash on a Saturday night. The app freezes. You can't close. Support is offline. You have to watch your account burn for 36 hours until the office opens on Monday. If they offer the asset, they must offer the support to back it up. Check their hours. 24/5 is standard for pure Forex. 24/7 is mandatory if they offer crypto. Do not compromise on this. Finally, we have to talk about the VIP tier discrimination. Many apps have tiered support. Gold members get phone support. Standard members get email only. This is explicitly telling you that unless you deposit $10,000, your crisis doesn't matter to them. While it is normal for high net worth clients to get a dedicated account manager, basic access to immediate technical help should be universal. If an app walls off live support behind a deposit threshold, they are telling you that small accounts are disposable. They expect you to lose your money quickly, so why waste human resources on you? Avoid these caste systems. Look for brokers that democratize support. A beginner with $500 needs more help than a pro with $500,000, not less. So, here is your support stress test. 1. Find the phone number. Call it. 2. Ask a technical question about margin or execution logic. 3. Check if they offer voice execution for emergencies. 4. Gauge if they are helping you or selling to you. 5. Verify they have a formal ticket system for trade disputes. If they pass this, you know that when the technology inevitably hiccups, you have a safety net. You have a partner who will answer the phone. But there is one final trap we need to navigate. You have the right broker, the right fees, the right tools, and the right support. Now, you need to learn how to trade. This is where the apps try to hook you in for the long haul. They offer academies, signals, and copy trading. They promise to teach you to be a millionaire. But most of this education is junk food for your brain. It is designed to make you feel smart enough to trade, but keep you dumb enough to lose. In the next part, we are going to audit the education and community ecosystem. We will expose the signal provider scams hiding inside legitimate apps and show you how to differentiate between marketing fluff and genuine institutional-grade education. We are going to show you what real learning looks like. The industry calls it education. We call it onboarding. There is a massive conflict of interest sitting right at the heart of most trading apps. The broker makes money when you trade. Therefore, their educational content is rarely designed to make you a patient, disciplined, risk-averse trader. It is designed to give you just enough confidence to deposit your money and start clicking buttons, but not enough competence to actually survive. It is the equivalent of a casino giving you a pamphlet on how to play blackjack that explains the rules but conveniently leaves out the mathematical house edge. Part 9 of this masterclass is an audit of the education and community ecosystem. This is where the psychological traps are laid. You need to learn how to differentiate between marketing fluff designed to accelerate your deposit and genuine institutional-grade material designed to prolong your career. Let's start with the Academy tab found in almost every app. Open it. What do you see? Usually, it is a series of 3-minute videos with titles like, "What is a pip?" or "How to place a buy order." This is not education. This is an instruction manual for the machine. Knowing what a pip is does not teach you how to trade any more than knowing what a steering wheel is teaches you how to drive in rush hour traffic. A professional app's education section looks different. It doesn't just define terms. It teaches concepts. Look for content on risk management, trader psychology, and macroeconomic theory. If the advanced section of their academy is just explaining a head and shoulders pattern, that is a red flag. Patterns are easy. Risk management is hard. A broker that invests in teaching you about position sizing, drawdown control, and the psychology of loss is a broker that wants you to survive. They are playing the long game. They want you to be a client for 10 years, not 10 days. Now we arrive at the most dangerous feature in the modern retail landscape: copy trading and social trading. The marketing pitch is seductive. Don't know how to trade? Just copy the pros. Look at CryptoKing99 here. He's up 500% this month. Just click copy and you get his returns. This is a financial death trap disguised as a feature. Let's break down why using a forensic lens. First, look at the leaderboards. They are almost always ranked by return on investment, ROI. This biases the list toward high-risk gamblers. If a trader risks 50% of their account on a single trade and wins, they have a 50% ROI. They look like a genius. The app puts them at the top of the list. You copy them. The next day they risk 50% again and lose. They blow up. You blow up. We call this survivorship bias. The app shows you the winners of the last coin flip. It doesn't show you the graveyard of accounts that tried the same strategy and failed. A professional checklist requires you to dig deeper into the signal provider's statistics. Does the app allow you to see their max drawdown? This is the most important metric. If a trader has 500% profit but a max drawdown of 80%, they are not a trader. They are a gambler on a lucky streak. A professional app highlights drawdown before profit. It warns you. A predatory app hides drawdown behind a More Details tab. Furthermore, consider the latency arbitrage of copy trading. When the master trader executes a trade, that signal has to travel to the server, be processed, and then be replicated in your account. In a fast-moving market, this delay, even if it is just a few hundred milliseconds, causes slippage. The master trader buys at 1.1000. By the time your account mimics the trade, the price is 1.1005. You are entering 5 pips worse. Then they sell for a 10 pip profit. You try to sell, but slippage hits you again. They make money. You break even or lose. Over hundreds of trades, this friction destroys the edge. Unless the app has a specialized, low-latency ecosystem specifically built for this. Copy trading is mathematically stacked against the copier. Then there is the community, or social feed. Many apps have integrated a Twitter-like feed where users can post their thoughts. Buying gold now. Euro is going to the moon. This is the echo chamber. Imagine if you were a doctor performing surgery, and you had a room full of random people shouting advice at you. Cut the red wire. No, use the scalpel. That is what a social feed does to your trading brain. It introduces herd mentality. Most retail traders lose money. Therefore, the consensus opinion of a retail social feed is statistically likely to be wrong. If you see a feed where 90% of the users are bullish, a contrarian professional sees that as a sell signal. However, a high-quality app curates this environment. They don't just let anyone post. They have verified analysts or market strategists. These are employees of the brokerage with credentials, CFA charter holders or veteran traders, who post analysis. They don't post buy now. They post charts with scenarios. If price breaks 1.05, we look for support at 1.04. If it holds, we look for a retest of 1.06. This is professional discourse. It helps you plan, it doesn't tell you what to do. Your checklist needs to differentiate between a chat room, noise, and a research hub, signal. Let's discuss the webinar versus seminars dynamic. A good app offers live education. Why is live important? Because the market is dynamic. A pre-recorded video from 2019 cannot teach you how to navigate the inflation crisis of today. Look for an events calendar. Do they have daily or weekly live sessions where you can ask questions? Hey, can you look at the USD/JPY chart? If the analyst pulls it up and breaks it down for you in real time, that is immense value. That is mentorship. If the app offers zero access to human expertise, you are isolating yourself. We also need to talk about the in-app tools that masquerade as assistants. Things like pattern recognition scanners. The app sends you a notification. Bullish flag detected on GPUST. Sounds helpful, but ask yourself, how is this pattern defined? Is it just a simple algorithm connecting three dots? Algorithms are terrible at context. They might see a bullish flag, but fail to see that it is forming directly into a massive resistance wall on the weekly timeframe. Blindly following automated pattern scanners is a recipe for disaster. However, these tools can be useful if you use them as a watch list generator. The scanner finds the setup, you do the verification. The app must emphasize this distinction. If the marketing language says guaranteed winning patterns, run away. If it says automated technical analysis scanner, that is a tool you can verify. Now let's look at the incentive structure of the educators. Some apps feature guest educators. Dig into who these people are. Are they independent traders? Or are they introducing brokers, IBs? An IB gets paid a commission when you trade. If the educator is an IB, their advice will always be biased toward high-frequency, active trading. They want you to trade a lot because that is how they get paid. They will teach you scalping strategies that generate lots of commissions, rather than swing trading strategies that might be more suitable for your lifestyle but generate less revenue for them. Genuine education is volume agnostic. It teaches you to sit on your hands. It teaches you that sometimes the best trade is no trade. If you never hear an educator in the app say, "Today is messy, we are staying out of the market," then you are not in a classroom. You are in a sales pitch. Finally, evaluate the onboarding pathways. A superior app asks you about your experience level during setup and customizes the interface and education feed. If you say, "I am a beginner," it should hide the complex options trading interface and push the Risk Management 101 course to your dashboard. If you say, "I am an expert," it should give you the raw API keys and the advanced macro research. If the app treats a total novice and a 20-year veteran exactly the same, offering the same generic how to trade videos, it shows a lack of sophistication. Personalization is key to safety. So add this to your checklist. 1. Does the Academy teach psychology and risk, or just how to click buttons? 2. Does the copy trading platform show max drawdown clearly? 3. Is the social feed a noisy chat room or a curated research hub? 4. Are there live daily sessions with credentialed analysts? 5. Does the content encourage patience, or does it hype up action? You have now filtered out the noise. You have a broker that provides safety, fair execution, transparent costs, and genuine education. You have built a fortress. You have stripped away the marketing lies and found the machinery that actually works. But there is one final step. The most terrifying step. The step where theory becomes reality. You have to fund the account and execute your first live trade. This is where most people freeze. Analysis paralysis sets in. Or worse, they skip the final safety check, the go/no-go launch sequence, and make a funding error that costs them their bonus or gets their funds stuck in compliance purgatory. In the 10th and final part of this masterclass, we are going to give you the launch protocol. We will summarize the entire checklist into a rapid-fire scorecard, and then we will walk you through the exact steps of your first deposit and your first live execution. We will show you how to test the waters with a probe trade before you commit your capital. The deep dive is almost over. It's time to prepare for launch. You are standing at the edge of the diving board. You have spent the last 9 sessions analyzing the water quality, checking the depth, inspecting the structural integrity of the board, and verifying the lifeguard is on duty. Now you have to jump. This transition, from the theoretical safety of a demo account to the visceral reality of a live account, is where the vast majority of aspiring traders fall apart. They assume that because they vetted the broker, the danger is over. But the danger is just beginning, because now the variable isn't the app. It is you and how you interact with the financial plumbing of the institution you have chosen. Welcome to the final part of our masterclass. This is the launch protocol. We are going to walk through the precise step-by-step sequence you must execute to transition from an observer to a participant. We are not just going to fund an account. We are going to run a live-fire stress test on the broker's banking infrastructure using a strategy known as the probe trade. First, let's consolidate everything we have learned into a final rapid-fire go/no-go scorecard. Before you enter your credit card details or authorize a wire transfer, you must mentally check these boxes. If any single one is unchecked, you abort the launch. 1. Regulation. Have you verified the license number on the official government website of the regulator? NFA, FCA, ASIC? If the license is pending or corporate, stop. 2. Costs. Have you calculated the true cost of the spread plus commission? Is it competitive? Have you checked the swap rates to ensure you aren't being bled dry overnight? 3. Execution. Have you confirmed the app offers market execution to avoid requotes? 4. Data. Do the charts run on New York close time to prevent Sunday candles from distorting your technical analysis? 5. Safety. Have you disabled one-click trading to prevent accidental fat finger orders? 6. Support. Have you called the phone number and spoken to a human being who answered a technical question correctly? If you have 6 green lights, you are ready for the funding phase. Here is the golden rule of funding. Never, under any circumstances, deposit your full trading capital on day 1. If you have saved $5,000 to trade with, do not wire $5,000. You are going to perform a probe deposit. Deposit the absolute minimum required to open the account, usually between $50 to $200. Why? Because we need to test the KYC, or Know Your Customer efficiency. Every regulated broker is required by law to verify your identity. You will upload your passport and a utility bill. Watch closely what happens next. Does the approval take an hour? Or does it take a week? If it takes a week of back-and-forth emails where they claim your document is blurry, when it is clearly 4K resolution, this is a stall tactic. It suggests their compliance department is understaffed or incompetent. If they make it hard to get in, imagine how hard it will be to get out. Once your account is verified and the probe deposit is land, do not start trading your strategy. You are going to execute a probe trade. This is a 0.01 lot trade, the smallest size possible, on a major pair like Eurus during a liquid time like the London Open. You are not trying to make money here. You are buying data. Open the trade. Immediately take a screenshot of the order window and the fill window. Compare the requested price with the executed price. Was there slippage on a 0.01 lot? There shouldn't be. If you slipped on a micro lot in calm markets, you will be destroyed on a standard lot in volatile markets. Next, check the trade receipt or daily statement the next morning. Look at the commission charge. Does it match exactly what was advertised? We have seen cases where brokers advertise $7 per lot, but due to exchange rate conversions, the actual charge ends up being $7.50. Those 50 cents add up. You are auditing their math. Now comes the most critical step in this entire 10-part series. The step that 90% of traders skip. The withdrawal test. Before you ever trade with serious size, you must try to withdraw your probe deposit. You put the money in, you did one microtrade and now you want it back. Request a full withdrawal of your remaining funds. This is the moment of truth. A legitimate broker will process this within 24 to 48 hours. No questions asked. A predatory broker will panic. They will call you. An account manager will reach out and ask, "Why are you leaving? Is there a problem? We can offer you a better spread." They might delay the withdrawal, claiming security checks. They might point to a hidden clause in the terms and conditions that says you cannot withdraw until you have traded a certain volume. If you encounter any resistance, any friction whatsoever, when trying to withdraw your own money, you do not deposit your $5,000. You walk away. You have lost maybe $10 in wire fees, but you have saved $5,000 from being trapped in a Ponzi scheme or a Hotel California broker where you can check out anytime you like, but you can never leave. This brings us to the deposit bonus trap. During the funding process, you will see a checkbox. Claim 100% welcome bonus. Do not check this box. I repeat, decline the bonus. Free money does not exist in finance. If you accept a bonus, you are accepting a legal handcuff. The terms usually state that you cannot withdraw any of your funds, not even your original deposit, until you have traded a volume equivalent to the bonus amount divided by some arbitrary number. Usually, the math works out that you have to trade hundreds of standard lots to unlock your own money. The probability of a beginner blowing their account before reaching that volume threshold is near 100%. The bonus is designed to lock your capital in the ecosystem until you lose it. Keep your capital liquid. Decline the bonus. Once you have passed the withdrawal test, you can redeposit your trading capital. But now you do it with confidence. You know the pipes work. You know the exit door is unlocked. Now let's talk about the psychological switch. You are now live. The candles look the same as they did on the demo, but they feel different. When the price moves against you, you will feel a physical reaction. Your heart rate will increase. Your palms will sweat. This is the cortisol spike. It impairs your cognitive function. On a demo, you were trading with your prefrontal cortex, the logical part of your brain. On a live account, you are fighting your amygdala, the fear center. The app you chose plays a massive role here. Remember the P&L flashing we discussed in the UX section? If you find that the flashing red numbers are causing you to panic, go into the settings and switch the display from currency to pips or points. Seeing that you are down 20 pips is an abstract data point. It is manageable. Seeing that you are down $200 is an emotional trigger. It represents a car payment or a grocery bill. By masking the currency value, you allow yourself to trade the chart, not the money. This is a professional UI hack that can save your career in the early stages. Finally, set up your emergency protocols. Save the broker's dealing desk phone number as a favorite in your contacts. Write down your account number and your phone password, which is different from your login password, on a physical sticky note and put it on your monitor. If your internet dies, you do not want to be scrambling to find your account number. You want to be able to dial, recite the number and say, "Close all positions at market." Preparation is the antidote to panic. You have now completed the journey. You started as a prospect looking for an app. You navigated the minefield of regulations, dissected the hidden costs of spreads and swaps, stress-tested the execution engine, audited the data integrity, optimized the interface for safety, and verified that a human will answer your call. You have proven the banking rails work and you have rejected the siren song of free bonuses. You are no longer a user of a trading app. You are a client of a financial institution. You have treated this process with the professional respected demands, and because of that, you have given yourself the highest possible statistical probability of survival. Most people lose money in Forex not because they can't read a chart, but because they are fighting a war on two fronts, against the market and against their own broker. You have just won the war against the broker. You have eliminated the counterparty risk. Now it is just you and the market. The market is unforgiving. It does not care about your feelings, your needs, or your dreams. It is a ruthless mechanism of price discovery. But at least now, you know that the tool in your hand is honest. The sword is sharp. The shield is solid. The rest is up to you. Trade safe. Trade smart. And never stop vetting the tools you trust with your future.